The SEBI proposes an overhaul of mutual funds fee structure. What would this actually mean for investors and for the industry? That's the discussion on NDTV Profit. I'm Hiral Dadia. First up, let's quickly understand what are they saying. The SEBI plans big changes in the mutual fund fee industry, which means that mutual fund investors probably will get cheaper. All this is at proposal stage. They want to cut the overall charges and make costs clearer for investments. Apart from that, this aims to make investing cheaper and more transparent as well. And in addition, they've proposed lowering fees by almost up to 0.15% for open-ended and 0.25% for close-ended schemes. This is a change from SEBI's 2023 rules that bundled all costs together, and this would include charges within the overall expense ratio as well. If you talk about the current AUM slab, it ranged between 1.05 to almost 2.25%, and this is basis the AUM of 0 to 500 odd crores to going up to more than 50,000 odd crores. Now, what changes from here on and what is the proposal is what we need to look at. If you can go to the next slide, that tells you that they are proposing lowering the total expense ratio, which is the TER, by up to 0.15% to on open-ended mutual funds and by up to 0.25% on close-ended schemes as well. Now, what is the impact? This will impact investors where they will see higher net returns. And if you talk about the lower expense ratio, that actually will come down to a higher net asset value, which will in turn become a higher investment as well for the investors. Now, how is the impact on asset management companies looked at? Firstly, this would actually pressurize the revenues of the companies. It would squeeze the profitability as well of all these fund houses. They will have to focus on efficiency and scale from here on if they want higher fees, because you're talking of a voluntary performance-linked fees as well. So the moment the performance is good, the fees probably can go higher, but again, there is a cap to that. Moving on, if you talk about the brokerage cost for cash, the current is around 12 basis points. They're expecting it in the proposal. They proposed a 2 basis points brokerage cost there, and for derivatives from a 5 basis points, they've proposed a 1 basis points. The impact will be that it will prevent investors from paying twice for research, increasing transparency as well. Secondly, the additional 5 basis points, if you look at it, currently they're allowed across schemes as a transitionary measure, but the proposal is to remove it completely. The impact is that it actually removes a cost that was meant to be a temporary cost, and it is pretty much transitionary in nature as well. Now, when you talk about the base expense ratio slabs, the current is a fixed fee limit where they've proposed to raise the fee limit by 5 basis points for the open-ended schemes, and this will actually help AMCs to cushion the impact of removing that additional 5 basis points charge. So this is a mitigating factor for the AMCs as well that SEBI has been proposing. The statutory levies, if you talk about them, the current one is that most taxes are included in the mutual fund fees, but the proposal is to show these taxes separately, so there will be transparency from here on, and all future charges in government taxes will be passed directly to the investors. So that is what we are looking at overall in terms of where mutual funds go. The key over here is that will mutual funds actually become cheaper or not? This is the existing approximate TER ratio of HDFC AMC, Birla AMC, UTI, Nippon, SBI Small Cap Fund. This is what we're looking at in that range of 1.5 to 1.65%. But yes, if this comes into practice, probably your funds will become cheaper, your returns will be higher. So that's what we are watching out for so far. In fact, we also spoke to Firoz Azeez today on what is the kind of impact he's looking at. Let's quickly listen in of what he had to say.
Whether you think this is good or bad depends on who you are and which side you're sitting on. So for a lot of your investors, I suppose this is just what the doctor ordered. How are you looking at it?
See, I'm looking at it. In fact, I think it can, if all of us sit on the side of the client, which is what I think in financial services is a fiduciary responsibility you should, we'll all see this circular as a great circular, point one. Of course, there are some scopes of improvement, and that's why it's a consultation paper. Now, if you break this down into economies of scales, transparency, and investor rights, and break this down, of course, there's a lot to talk about. if your viewer wishes to know. Basically, when it looks at, like Charu was mentioning, the slab rates, one thing which I think every viewer should take a note, it is slab-wise as an income tax slab. So even a scheme with 1 lakh crore will have these 225 to 1.75 and so on and so forth. These are like income tax slabs. That's point one. Point two, transparency need was extreme. As a distributor, it becomes very difficult for us to comprehend what is the distributable TER. There are two concepts, which is called total expense ratio and distributable expense ratio, DTER. For us to understand what should be our brokerage, we have to arrive at distributable TER of the asset management company. In spite of having 20 people doing only mutual fund research, they find it difficult to arrive at the distributable TER because each expense of each scheme is different. Somebody is paying more brokerage if there's more churn. So transparency need 10 on 10. Economies of scale, I think SEBI has to acknowledge one point, that economies of scale in the entire value chain don't exist. An asset management company has very little fixed costs, has very little variable cost beyond a certain point. But a distributor has a consistent variable cost and lesser fixed cost. So economies of scale should be seen with very, very different lens, in my opinion. If in 10 years the customer should get great service, he needs to have the distributor alive. Especially when there is a direct scheme for a person to cut the distributor and go, then you should not ideally in the long run tinker around too much with the regular scheme, so that there is some longevity. I'll stop here, Tamanna.
Absolutely. Firoz, good morning.
In fact, that's an interesting conversation. In fact, Alex also spoke to Ashish Somaiya of White Oak Capital AMC to understand what would this actually mean. This is basically an all you need to know of the SEBI proposal with regards to MCs. Let's listen in.
So let's start with some of the changes that are coming through. And I see about 5 heads. But the headline seems to be that base TER itself is supposed to be heading lower by as much as 15 basis points for your open-ended schemes and 25 basis points for your close-ended schemes. Is that correct?
Yeah. Yes, and little bit more also, Alex, because there is that another 5 basis points which was put up as saying that in the past what was happening was that if you redeemed from a mutual fund, there used to be an exit load. Now in 2012, that exit load was said that AMCs cannot charge any exit load. Whatever exit load, if any, has to be credited back to the NAV of the scheme. So obviously AMCs had some commercial loss because of that. So in lieu of that removal of exit load, the TER was increased by 20 basis points. Then after some time, that 20 basis points was made 5 basis points. And in the latest proposal, that 5 basis points has been completely kind of done away with. So not only the base TER related matter which you described, which seems to be on an average, depending on the slab, somewhere 15 bips, somewhere 10 bips. But apart from change in base TER, even that 5 basis points of exit load related expense, that also will go down. So net for investors, I think there will be a reduction in TER.
Okay. So, but that 5 basis points that you said for the exit load, not everybody was charging it. Is that correct?
No, by and large, most equity funds had, some or the other exit load. And in lieu of that, there was, a practice of charging 5 basis points. I think it would be quite common. I mean, I don't think that it is a rare phenomena. So that you should count that, it will be resulting in a 5 basis points reduction there also.
Okay. Where is this 15 basis points reduction in total expense ratio and 10 basis points, as the case may be, coming from? Because there are a couple of changes that are being proposed. One is that your statutory levies, which is your STT, which is your GST, which is your stamp duty, all of that cannot be included in the total expense ratio. And so therefore it has to be passed through to the consumer. Ultimately, the consumer will be paying it, or the investor will be paying it. It's just that it's not included in the TER. Is that the right interpretation?
Yes, but so I'll tell you a couple of things. As of now, what I understand is that the reduction, if the proposal goes through as is, because we should not forget it's a proposal, it's not like happening tomorrow morning. So what we should keep in mind is that if you actually see, let's say there is a reduction in TER and there is, some components which were statutory levies, which were inside the TER, they are removed out. My sense is that the statutory levies and the components which are being removed from the TER and being allowed to charge plus, I think that component is less than what the actual reduction in TER is. So it's not like, okay, TER is reduced, but some other components are being allowed to charge, so net impact is zero. No, that's not the case. In whatever I've understood till now, it's just early days, but what I've understood till now is that the components which are being allowed to charge outside TER, the value in basis points of those components is less than the actual reduction of TER which is being proposed. So my sense is that still a few basis points, say give or take, 10, 11, 12 basis points of reduction in TER will still happen even if you remove those components and allow them to be charged separately. The other thing I'm sure which you will come up with and we will discuss it is that for investors, it's not just about reduction in TER, but also, the alpha generated or the returns will go up, because I'm sure we'll discuss about the reduction in transaction costs, which is mainly related to the brokerage that mutual funds incur.
I was coming to that
is
because
also a big one. Yes.
I was coming to that because, and this is outside of the TER. Would you explain that? Because the brokerage and transaction fee is reduced to 2 basis points for cash and to 1 basis point for derivatives from 12 and 5 basis points respectively. What are the implications of this, Ashish?
So, what happens is that when we look at the total expense ratio, that does not include the cost of buying and selling securities, which mutual funds incur on behalf of their customers. So what will happen is that typically if I buy, say, 100 rupees worth of any stock, okay, and the brokerage is, let's say, brokerage exchange related fees. By the way, let me clarify that in a lot of the regulatory discussion, it is coming up that 12 basis points is the brokerage. That 12 basis points is not brokerage, or 10 basis points, whatever they said, is not brokerage. Definitely, cost of buying and selling, which is the brokerage paid to secondary market brokers, that is a part of that, but fees paid to exchanges, securities transaction tax, stamp duty, a lot of these other components are also included in that. So it's not like a cap of 12 going to 2. The point is that it needs to be clarified that everything doesn't go to brokers. So it's not like 12 becoming 2, it will be more like, a cap of 12 becoming more like 5-6 basis points or something. And in the past, why we are clarifying it was not part of TER is because, let's say if I buy a stock for 100 rupees and the exchange fee, STT, brokerage, all of that is, let us say, 0.1%. So the cost is not 100, the cost is 100.1. And when you sell, you're not selling for 100, you're selling for 99.9. So what happens is that all these transaction costs, we call that they are capitalized into the acquisition price or sale price. That is why they are outside the TER, because you cannot count them in the TER because they get capitalized with the purchase price or the sale price of the securities. So going forward, instead of say 100.1 in the example which I gave, when we buy, we may not buy for 100.1, we may end up buying for 100.05. And when we sell, we may not sell for 100 becoming 99.9, we may sell for 99.95.
Sure.
And you can imagine that in any given year on an annualized basis, mutual funds have significant amount of buy-sell transactions. So on every buy-sell transaction, if we start saving 0.05%, it adds up. So even on that, like apart from the 10-12 basis points, which I am expecting as a reduction in TER, I am expecting that another, maybe 15 or 10 to 15 basis points reduction will come if this proposal for brokerage reduction also goes through. So for investors, returns and alpha generated will go up is my expectation.
Okay. Short question, because this ultimately does not necessarily change anything for the investor, but it does change quite a bit for the broker. Is this particular aspect going to be negative for the broker?
Yes, I think it is a negative and to some extent unfortunate because, it's a misunderstanding that brokers only execute transactions. Definitely they provide a lot of other services as well. It is true that, asset management companies are supposed to do research and investment management in-house, and that is what the asset management fees is for. So that part is appreciated, and all of us, like, we have a team of 50 people in the investment and fund management team. If you see White Oak across, and I'm sure other AMCs have also built up their capabilities. But yes, so if the proposal goes through as is, and there is a reduction in the cap for brokerage, then yes, it is a negative on that front. And I think some of these things we have to watch for how the industry handles it, and if this proposal goes through as is, or how it's formulated finally.
Okay. A couple of more things that stood out, right? One is the allowance of that performance-linked charge, and this, I think, has been discussed by the industry for quite a while, where in an actively managed fund, if the fund manager is managing to consistently beat the benchmark, then the fund should be allowed to charge a performance charge. But it says that the proposal is going to be separately analyzed. Any idea how this would potentially look?
Yes, Alex. So I think, there has to be it's not easy or not simple to execute at all, because take a very simple example. Currently, the way that total expense ratio and management fee works, it's a very simple and cute solution, because, you enter any day, you exit any day. On a daily basis, we are debiting the scheme for the expense. I mean, we are accruing the expense every day and debiting finally at the end of the month. But everything is absolutely proportionate. It's proportionate to how much money you invest and how many days you remain invested. On that, the percentage is applied on a pro rata basis. So it's very, very simple to implement. But when you say performance-linked fee, generally the notion is that the performance should be decided at the end of 1 year or at the end of 3 years. That, okay, have you beaten the index? Because we don't beat the index every day. But if you want to measure whether we've beaten the index, then you should measure us at the end of the year or at the end of 3 years, which means that any performance-linked fee will have to be charged, once when it is computed or when the performance is being judged. But in the period preceding the date of charging performance fee, different people may have entered at different points in time. So there is an elaborate mechanism which needs to be worked out as to how a performance-linked fee. That's why if you see the proposal also says that, it's just a proposal that performance-linked fee be allowed, but then a wider discussion needs to happen amongst all the stakeholders, that how will you actually implement it?
Yeah, and it's a difficult thing. I don't know if there's going to be a pushback at all, because while there is incentive, of course, to beat the benchmark, it doesn't always happen. It's not in the control necessarily of the fund manager. And ultimately,
so it's a welcome proposal. I mean, we would love to have schemes where we are rewarded for performance-linked. No,
100%. But I'm saying pushback from investors to say that if there is a significant underperformance, I'm still paying the full charge. Wouldn't that make sense?
Yeah, no. So, Alex, the implication would be, or I would assume, that if we are in this TER kind of structure where it is, say, give or take, anywhere ranging from 1.6 to 2.2, if we are in a performance-linked fee, then correspondingly, of course, the TER, the base TER or the fixed TER has to go down, and another component of performance-linked fee has to be built in. It can't be both.
Yeah, absolutely. Because that would be the icing on the cake, and there might just be too much then in the way that I don't want to eat so much cake, so to speak. Right, but but having said that, I just want to come to the crux of this, right? Because you will remember, if I'm not mistaken, in May 2023, there was a proposal that was made by the Securities and Exchange Board of India to overhaul the entire total expense ratio structure. And the proposal at that time was an overarching TER for actively managed equity schemes based on assets under management. Would you say that this is preferable to that?
Yes, of course. This structure, I mean, this proposal, what has come yesterday, is a lot more about, I still don't know. I mean, I said that it might end up reducing TER by 10-12 basis points. That is my first hand, or, first up my estimate, guesstimate, whatever you will call it. But beyond just any reduction in TER, etc., this whole proposal is a lot more about simplification. Because, if you have GST and so many of these statutory levies, which the government can increase or decrease, and if they all are inside the TER, then obviously it reduces transparency and it reduces understanding of how the TER should actually work. So this is a much more welcome proposal because it goes into simplifying and increasing transparency. The second reason why I find this proposal is quite interesting is also because in the previous proposal, if you remember, there was this discussion that, brokerage, etc., which we incur on secondary market transactions, that should also be within the TER. Whereas what this proposal says that, okay, let it be outside TER, just reduce how much cost you're incurring because you're anyway supposed to do your research on your own. So if you go back to the old proposal, it would have been quite difficult because then if you include the cost of buy and sell inside the TER, that means you are basically saying that, boss, do what it takes, don't do buying selling, reduce your buying selling activity, reduce your churn. Our main objective is to generate alpha. Our main objective is not to reduce transactions. I know we should not be just randomly making transactions because it increases friction and reduces operational efficiency. So I understand that. But in the best interest of investors, if we need to buy or sell something, we should be allowed to do that. And there should not be some artificial disincentive against doing the right thing.
But
clearly this proposal is more preferable.
And this is just the last point. Would you say that this directionally is aimed at curtailing some of those invisible costs in terms of research, etc., that were not necessarily clear to the investor?
Yes, I mean, for the investor, basically the point is that, if the transaction cost, let's say in the brokerage that is incurred, there is a certain element which is transaction cost and a certain element which is attributed to many other services.